Hi, I'm Cathy McBreen, president of Millionaire Corner, and we are delighted to have here today Luke Knecht, one of the foremost leading fixed income portfolio managers in the country. Luke, who you will meet in a moment, currently works as a partner at Dearborn Partners in Chicago, Illinois, which is a SEC registered investment manager. Prior to that, he worked at Dresner RCM Global Investments, and prior to that, he was the chief investment officer at Harris Investment Management. Hello, Luke. We're glad that you're here.
Thank you. I'm pleased to be here, Cathy.
So I read one of the articles that you've written, and it mentioned that it might be the time to look at your long bonds and really think about making them of shorter duration. Is that a correct statement?
Absolutely correct. That if you do own 20 or 30-year securities, and even if you bought them 7 or 8 years ago when rates were higher, and now they're only 13-year or 20-year securities, they still have substantial risk to a rising rate environment. So you've probably got gains in those. It might be a good time to realize some of the gains. And even if you have to take a lower interest rate in the short term to protect yourself against the decline in price that's going to happen, again, just do the math in your head. If you're got a 10-year security with a duration of 8-9 years, depending on the coupon, and we go from a 2.25 to, let's say, a 3% interest rate on 10 years, 75 basis points, your price is going to decline by some 7%, 6.5%, and that's going to be equivalent to maybe 2 years worth of income. So now the bonds ultimately mature. It's not like that decline in value can't be recouped. If you hold the bond to maturity, it will eventually pay back at par. So a lot of people think of losses in bonds as temporary. If I buy it at par and it goes down to 90, I know I'm going to get par back if I just hold on to it. And that's a valid observation, but you'd rather avoid the loss of it going from par to 90. So now might be a good time to rethink the maturity structure of your portfolio, and to the extent you can afford to, shorten the maturity structure of it to avoid the kind of losses that we experienced in May and could continue to happen in the future.
Thanks again, Luke, and thanks for watching Millionaire Corner.